Hello, I want to welcome everyone participating in today's webinar, Changes in the Employee Benefit Plan Landscape for 2020 and 2021 Audits. My name is Stephen Doolittle, and I'm a Senior Auditor at GRF CPAs Advisors, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you'll need to do to earn your CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically following the webinar. You'll be asked to recall these words in order to receive credit. Please write down the CPE words when they are given and keep them until you receive your certificate. They will not be provided again. If you have any technical questions or issues during the discussion, please use the questions function to speak with our administrator for assistance. The slide deck and recording from today's discussion will be available on the event page on our website. Technical support and CPE questions may be addressed to Nathan McElveen at the address noted there. Today's learning objective is to provide attendees with industry updates, guidance on 2020 changes, and preparations for new accounting standards under SAS 136. I will now introduce our speakers for today's webinar. Jennifer McCahill is a partner in the audit department here at GRF. Ms. McCahill has worked in public accounting for her entire career and possesses expertise in auditing and accounting for tax-exempt organizations. In addition to her role as an auditor, Ms. McCahill is also a leader in the firm's employee benefit plan practice, ensuring clients' compliance with the specifics of various plan qualifications. Andrew Dial is a senior auditor with GRF CPAs Advisors. He has been working in the firm's audit department since 2014. As a senior auditor, he is responsible for managing staff and ensuring that his audits are completed accurately and in an efficient manner, as well as drafting audit reports. Mr. Dial specializes in the auditing of nonprofit organizations and pension plans. I'll now turn the presentation over to our speakers.
Great, thank you, Stephen, and welcome everyone to today's webinar. I'm Jen McCahill, as Stephen mentioned, and I'll be kicking us off talking about a brief agenda. We look forward to the topics we'll be discussing today. Certainly relevant in pension season, which we just kicked off this month and will continue over the next couple months. So quick agenda, we're going to start with an industry update. We're really going to focus on some guidance that we've received coming out of the DOL and the IRS, what their top priority is recently, studies they'll be conducting, and how that will be relevant to you all. We will talk about the CARES Act, the changes which are for 2020, but will become relevant now if you all receive plan audits, which I assume most of you do, which is why you're attending today. But ultimately, we'll go through what those changes were under the CARES Act for 2020 and most of what your auditors will be asking and looking for, and some considerations for you all under those changes, even moving forward into the next couple of years. And then finally, we'll be talking about the meat of what we really want you all to focus on, be aware of, some more significant changes in the accounting world as it relates to new accounting standards, SAS 136, forming an opinion on the employee benefit plan audits. So that'll be some bigger changes we discuss at the end. We're going to start with a polling question. I'll turn it over to Stephen to kick us off here.
Yes, just a quick polling question to begin. Do you have a formal cybersecurity controls in place for your retirement plan? Yes, no, unsure. Please take a moment to answer. While participants are submitting their answers, I'll provide the first CPE word. The very first CPE word is retirement. If you want to receive your CPE credit, please jot this word down because you'll need it for the survey following the webinar. Again, the first CPE word is retirement, R-E-T-I-R-E-M-E-N-T.
Okay. So it looks like from the poll results, who voted, it's pretty split. 1/3 of you saying yes, there are controls in place, no, or you're just not sure, probably because you're not sure where the onus lies on who's responsible for those cyber security controls around your plan. So as we're all aware, cyber and data security certainly isn't something that's new to us. It's been a significant topic on a multitude of different aspects within any organization, certainly heightened by COVID and the past couple of years, while organizations are navigating moving those traditionally in-person controls, the traditional paper processes to a virtual environment. And really for retirement plans, even before then, a lot of you all moving your plans to a third-party service provider, a record keeper, an institution that specializes in maintaining the administration piece for retirement plans. So the topic of cybersecurity comes up a lot, and now it is on the DOL and EBSA's radar as it relates to retirement plans. Obviously, the plans holding millions and billions of dollars in assets have become a target. We've seen an uptick in the number of instances that are targeting these retirement plans. And unfortunately, the anticipation is just a continued target where any of these cyber or data issues can really get their hands on. So the DOL and EBSA have communicated that they're currently undergoing a big study on where organizations stand as far as the cybersecurity controls that they have in place. They're going to do this study over the next couple of years. They'll be looking at not only the service providers, so your traditional organizations, when we think of big service providers, TIAA or Fidelity, those are a few examples that come to mind as some of the larger ones, but they'll be sampling from those service providers as well as the plan administrators. They'll be taking a look at very large plans, multi-employer plans, as well as very small plans to gauge, what level of controls are currently in place. And as you'll see here, we've noted that there actually is no requirement as of right now. There's no formal guidance. There's no formal requirement on what retirement plans are to maintain at a minimum. So what will come out of this study that they have communicated is some formal requirements, some formal guidance that plans will be required to maintain. So we do look forward to seeing that. I think that'll be beneficial for the industry. So when we're talking about cybersecurity for the plans, while this is a forward-thinking topic, it's certainly, an industry update on what we need you all to keep in mind and be prepared to actually be able to comply in the future. One of the things that comes up most often is the onus of who this falls on, right? Because there are a lot of players within the retirement world for a plan. You have your plan sponsor, the employer, we have a third-party administrator, we have the actual financial institution holding the assets, we have record keepers. And so with a multitude of players, it's very hard to navigate, who's responsible for what and who ultimately will be responsible for ensuring that these cyber security controls are implemented and operating effectively. And so you always have to remember that no matter what level of outsourcing an organization does, in the eyes of the DOL, management is ultimately responsible for ensuring compliance with the plan. So the onus does fall on the employer, plan management, the plan sponsor, even if these controls are outsourced. So, for those reputable organizations such as Fidelity and TIA, who have millions of dollars to dedicate to controls and IT security controls, you all can do some minimal items. You could take some very simple procedures to ensure that they have good processes in place. We'll talk about that in a minute. We have included a link here to the DOL's current guidance that they've issued. Again, it's not formal. This is what they've put in place as what they consider best practices. And so if you click on the link, and I've cut out just an excerpt from what that link, if you open it, what it's posted. Here are what they consider best practices. Actually, if you take a look, the link is really easy to navigate. It's only 5 pages that they have put together, so you can easily read through it. It's easily digestible. And really, if you're looking at what they consider best practices, a lot of these are relatively simple to put in place. So, when we're talking about the cost and time and effort that it would take to comply, depending on the size of your plans, larger plans, we would expect to have almost all of these, if not more, and smaller plans can certainly pick and choose. But if you look at some of these, and I'm not going to go through all of them, but some of these just right off the bat, pretty simple, pretty intuitive, and generally relate to what you would see as best practices within any facet of your organization when it comes to cyber and data security controls, right? So having a formal, well-documented policy and program in place, that's first and foremost. If it's not documented, it doesn't exist. And so making sure that you have a policy in place that addresses, who is responsible for what, it assigns those roles and responsibilities, how often you'll be taking a look at the processes as it relates to cyber and data security. And this can be integrated with your normal financial management or overall organizational cyber plan. So, certainly doesn't need to be separate. But I think the point is that you're making sure that it does specifically address the plan assets that you hold. The other 2 things that I want to just quickly point out from this list, because I think it starts to make a good differentiation on, okay, but I as the employer probably don't have the tools to properly do that if it's outsourced. So if you take a look at number 3 and number 6, these kind of start to specifically address, okay, we recognize in the world that the plan administrator isn't doing all of these processes themselves. They're outsourcing this. So number 3, having a reliable annual third-party audit of security controls. This is really speaking to your SOC 1 reports, those service organizations that are receiving those service organization audits. You are, it's certainly a best practice that you are entitled and should be receiving the results of those audits from your third-party service provider. And you should be taking a look, if you get an audit from your third-party service provider and there are significant issues in their audit of their controls, that's something that you all as an organization need to assess. Can we really rely on this third party to do well by our plan? If they don't have the controls in place, what extra work may we do? So making sure you obtain those SOC 1 reports, SOC 2 reports. I anticipate that most definitely will be something at a minimum that all organizations will be required to do in the future after this study. And then number 6, ensure that any assets or data stored on a cloud or managed by that third-party service are subject to the appropriate security reviews and assessments. Again, so these are things that you all as the plan providers, plan administrators, will probably need to work closely with those third-party organizations to make sure that they're in place. And, again, this isn't something that's new. I'm sure you all have already started to address this on the overall organizational side. Third-party risk management has become a really big topic in the world these days. And so, if you don't have a formal third-party risk management process, that's something you should be taking a look at, because this will certainly fall under the purview of that process in the future. All right, turning it over to Stephen for our next polling question.
Yes, thank you. Polling question number 2. Did your plan allow employees to take advantage of changes under the CARES Act? Yes, no, unsure. Take a moment to answer now, please. And while participants are submitting their answers, I'll provide the second CPE word. The second CPE word is update. If you would like to receive CPE credit, please write this down because you'll need it for the survey following the webinar. The second CPE word is update. UPDATE.
All right, so we have about the same again. 1/3 of you said yes, you allowed your employees to take advantage of the CARES Act changes. Some of you said no, and this will still be relevant to you all, a topic for the audit anyway this year. And some of you just aren't even sure yet. So this will be very relevant to make sure that you go back and are prepared to answer questions on the CARES Act changes. So let's see here. There we go. So the EBSA Disaster Relief Notice 2020, it was issued last March when the pandemic hit, and it really gave some guidance and relief for employee benefit plans due to the COVID outbreak. So there were some significant changes, just a few, not too many. We've again included the link that you can take a look at the guidance here. It's actually, again, very easy to navigate. It's not a lot of information, and I think it's pretty straightforward. So unlike what you might think generally coming out of a government facility, it's easy to digest. So while 2020 is behind us, and I know it's seeming all the more normal as we continue on in 2021, and these changes were in effect for last year, so most of them expired at the end of 2020. It's going to be relevant in the context that if your plan is to undergo an audit, so right now we're doing a lot of the 2020 audits. These are things that your auditor will be testing. These are questions that your auditor will be asking you all. So you need to be prepared to answer them. And in some cases, you might even need to go back and rework with your provider some documentation to make sure that you have everything in place to address these one-time changes. So you all did have the option of electing this. It wasn't mandatory. So first and foremost, I think the first question that everyone is going to get from their auditor is, did you elect this? And for those of you that answered unsure, that's certainly something you want to go back. It will change how the auditor tests. It will change, what's in your financials. It'll change some disclosures. And ultimately, if you did elect, you will need to formally amend your plan. You do have some time to amend your plan. Right now, the guidance is until 2022. If you're not in a calendar year, it'll be your 2023 fiscal year. So you do have some time to amend, and we're still waiting on some further guidance from the IRS on what that will look like in the next year or two. But you want to make sure that you know whether or not your plan elected to implement these things. And so we'll quickly touch on two or three of the more significant items. So the changes under the CARES Act really related mostly to distributions and loans. So early withdrawal from an eligible retirement plan. So if your plan didn't allow for early withdrawal before, and you did elect to have this under the CARES Act, that's a significant change. You were allowed to take up to $100,000 between January and December of 2020. And traditionally, if you're taking money out of your plan early before you hit the retirement age or whatever the plan document says is the retirement age, you would be required to pay an additional 10% early withdrawal penalty on those funds taken out. So it could be a significant chunk of money in addition to any of the federal or state taxes that you elect to have on that withdrawal. So the CARES Act did say that even if the plan doesn't allow, you're allowed to take out $100,000, up to $100,000, and that 10% early withdrawal fee will be waived. The next two are more so on the individual tax return side, so not necessarily on the employer side, but I think it's important to know, if your employees are asking these questions, and that if they did take money, they can actually report it as income over 3 years, beginning in 2020. You don't have to report it over 3 years. You could take it all in 2020 if you want, but they did have the option of reporting it on their personal income taxes spread evenly over 3 years. And then they can repay the distribution within 3 years of receipt. So this is interesting because obviously, if, again, this is more on the personal tax return side, but if they reported it as income and then they decide to repay it, the individual would work with their accountant CPA and their personal return to amend previous year income reported. But if they do repay a distribution back into the plan in the next 3 years, being 2020 through 2023, it will be they are allowed to do that, and it will be presented as a rollover into the plan. So that's something that could come up that you may see in the next several years as a result of the change in the CARES Act. The other bigger change was related to the loans. So loans up to $100,000, the old limit, you were capped at $50,000 in what you could take, or you could take 100% of your vested balance as long as it was under that $100,000. And it was within the 180 days after the following of the enactment of the law, so March 27th. And then the other component to that is that if an employee did have a loan that was due with after that March 27th date, they do have the option to extend it and delay repayment for up to 1 year. We often get questions, if my plan doesn't allow for loans, can they still take a loan? No. The answer to that is that the plan isn't set up. And then early distributions, interestingly enough, if the plan didn't allow for early distributions, they can still take the distribution. It wouldn't be, and then the distribution is reported ratably over the 3 years in accordance with the new rules on the personal income tax side. So that was a unique little nuance in the guidance there. And then the last thing here, who was eligible to take advantage of these changes. So eligibility, which I was going to talk about on the next slide, but I can talk about it here. And I just jotted down eligibility. It was anyone who was you or your spouse or dependent was diagnosed with COVID, or you have experienced a financial hardship because of either quarantine, you were laid off, reduced hours, you were furloughed, if your business closed, and then if you couldn't find childcare and that impacted your financial hardship, you were ultimately eligible to take advantage of these changes. The only other thing I'll mention as a result of the CARES Act, which I think is will be far less common. However, I've already seen one instance in which this is the case, but partial terminations, which historically, if you reduce the workforce by, I believe it's 20%, and all my slides are messed up here, but if you reduce your workforce by 20% or more of qualifying individuals, that's your traditional in which it would trigger a partial plan termination. Well, the IRS changed the definition of this partial plan termination under the guidance, saying that you would compare the balance of qualified individuals on March 13th, 2020 to March 31st, 2021. And if the number of active participants covered by the plan is at least 80%, then it won't trigger that partial plan termination. And so I think, this is important because a lot of our organizations did have significant layoffs, but it obviously the IRS changed the guidance to be able to give employers time to restaff up. And so far less often that I think we'll see this, but I think it will come up periodically. And something to be mindful if you're like, oh, we did have a significant layoff this year. Will my retirement plan trigger a partial plan termination? That's something you probably want to take a look at. So the next two slides really focus on, okay, these changes happened. I either did or didn't implement them, or I don't know if I implement them. What am I going to be responsible for as the employer as far as documentation? So the guidance does say, if you fail to follow any of your procedural requirements for plan loans or distributions, that the department will not treat it as a failure if it's attributable to the pandemic. You're making a good faith effort to comply with those requirements, and you're making a reasonable attempt to correct any deficiencies, such as going and getting that documentation. So that's important. In that, the sense that what traditionally would be considered failures, you might have a little reprieve because of the pandemic. So that's really good to know. And then the documentation factor, what are you all responsible for as far as documentation with respect to these changes? Well, we already talked about the actual formal amendment of your plan. So you do have some time, but you will be responsible if you did adopt for formally amending your plan to retroactively include these changes. Again, we're waiting for some more formal guidance on that. So you're responsible for the formal amendment. And then the documentation when it comes to the distributions and the loans. So this excerpt is from the IRS's kind of Q&A because they were getting this question a lot. May an administrator and employer rely on an individual certification that they were eligible? So an individual comes to you and says, I'm having a financial hardship, or I've been impacted by COVID, I need this distribution, or I need this loan, or went to the third-party service provider and did it directly. So the guidance is that the administrator is you all can rely on an individual certification that they met the conditions of being an eligible participant. They met those eligibility requirements. And so they're actually not saying that you all as the employer administrator need any other documentation besides the employee statement that they qualified. So, traditionally in like a hardship withdrawal, you would need proof of the financial burden. Here, they're not asking for employers to maintain that level of record. And so it really does just come down to a statement from the individual that they were qualified. So this is something that the auditors will be looking for, and for you all just making sure that you do have an understanding of who took advantage of the CARES Act and whether they have attested to the fact that they met the requirements for being an eligible individual. And we included this link for the IRS Q&As related to all these changes. It's super easy to navigate and very straightforward. I do think it's a great link to have. So I'm going to quickly breeze through these other items. I think, you know, some of the more common changes that we're seeing, plan administrators are the point in contact is changing during the year. So these are things that you need to consider in internal controls that might lend to an increased risk in your plan during 2020, even through 2021. The instance of furloughed employees could change, you know, how you traditionally are looking at eligibility, or the fifth bullet point down, compensation. If there's any reduction in compensation due to, you know, furloughs, freezes, COVID bonus payments, making sure that you know how those will play into compensation and that definition for plan related purposes. That's always a hot topic that the DOL is looking for, and something that your auditors will be taking a look at. Frozen employer contributions, that's super common, and we've already seen several of those. And then contractors that are administering the plan, or again, back to the change in employees. Oftentimes they're not as you know, well-versed in the details and the intricacies of your specific plan. And so again, making sure that if you did have any of these situations in 2020, maybe you go back and do some internal audit and spot checking on procedures and compliance with your plan document, because outside of the distributions and loans, there's been no reprieve for other things such as that compensation or timely remittance of those contributions, or getting those employer contributions correct based on the employee changes. So these will be things that I think are great for you all to take a look at or think about as you approach your 2020 plan audit.
Okay, we have come to polling question number 3. Are you aware of the changes to limited scope audits under SAS 136? Yes, no, unsure. Please take a moment to answer now. While participants are submitting their answers, I will give the third CPE word. The third CPE word is investment. If you want to receive CPE credit, please write down this word because you'll need it for the survey following the webinar. The third CPE word is investment. INVESTMENT.
Okay, so most of you, 72% of you aren't aware of the changes related to SAS 136, which is great because we're going to go over them and what will be most relevant for you all next year. This takes effect for the year that you're in now, 2021. So next year's audits, these will be really relevant. So I'm going to turn it over to Andrew to kick us off with these changes.
Yeah, thank you, Jennifer. Thank you, Stephen. My name is Andrew Dial, and today I will be discussing SAS 136, and I'm going to be going over some of the changes that have come about under the new standard. So first and foremost, I think probably the most important and biggest change is that the audits formerly known as limited scope audits will now be considered ERISA Section 103A3C audits. And these ERISA Section 103A3C audits are no longer considered to have a scope limitation, which means the auditors will no longer be issuing a disclaimer of opinion. Instead, the auditors will be issuing a two-pronged opinion. The first part will be over the audit, and the second part will be over the procedures applied to that investment certification. So it's not surprising that under SAS 136, they've also enhanced the procedures that need to be applied to this investment certification. And under the new standard, the plan sponsor is actually required to do an assessment and an analysis over that investment certification. And the auditors will be requesting management's analysis, and the auditors will be performing their own procedures over that analysis. So the Employee Benefit Plan Audit Quality Center actually put together an extremely helpful tool to help management make that assessment, and we will be going over that in detail in a few minutes here. So kind of related to that two-pronged opinion that I discussed, the auditor will now be reporting on specific plan provisions and whether or not the plan has complied with those provisions. So the audit opinion under these ERISA Section 103 A3C audits will look very different than that limited scope audit in the past. So under SAS 136, they also clarified and expanded the plan sponsor's responsibilities as well as the auditor's responsibilities. So the plan sponsor is required to assess whether the certifying institution is qualified. And again, we will be discussing that in more detail in a few minutes here. The plan sponsor is also responsible for the certified investment information and whether that is appropriately measured, presented, and disclosed in accordance with the applicable financial reporting framework. The plan sponsor is also responsible for maintaining a current plan document and amendments, as well as maintaining sufficient participant records. So if we look back up here at that second bullet point, the plan sponsor is responsible for the certified investment information and that it's appropriately measured, presented, and disclosed. Well, what exactly does that entail? So it really means that the plan sponsor's responsibilities do not end when they receive that investment certification. You're actually required to have an understanding of the measurement basis used to value those investments. And that's particularly true for any of those alternative investments that the plan holds. So management is required to have a fair value measurement analysis over all of the assets held by the plan. And when it comes to those alternative investments, you may need to reach out to the certifying institution and obtain some additional details on how they valued those assets. In some situations, you may need to request an amended certification to either cover those investments or perhaps to exclude those investments from the certification. If there is a situation where investments are excluded from the certification, it is your responsibility to engage with an auditor to have those investments audited. Now, the auditor's responsibilities are to communicate reportable findings. And these reportable findings include issues of non-compliance, and that could be non-compliance with plan provisions or DOL rules and regulations. It could also be indications of deficiencies in internal controls. Also, the auditor is responsible to obtain and review a draft Form 5500 before dating the audit report. So before the audit report goes final, the auditor is required to review a Form 5500 that is substantially complete, which means it includes all forms and schedules that could have a material effect on the form. So do any of the changes affect plan management? Well, as part of the auditor's acceptance of the engagement, they will ask plan management to acknowledge the responsibility for maintaining the plan, administering the plan, and providing the draft 5500. Additionally, the auditor is required to obtain written representations from management that management elects to have an ERISA Section 103 A3C audit, that an ERISA Section 103 A3C audit is permissible, that the investment information is prepared and certified by a qualified institution, that the certification meets the Department of Labor requirements, and that the certified information is appropriately measured, presented, and disclosed in accordance with the applicable framework. So on this next slide, we've actually embedded the PDF for that assessment tool that we discussed earlier. So again, this was developed by the Employee Benefit Plan Audit Quality Center. It's about 8 pages long. I highly recommend reading through this entire document. It provides some extremely beneficial information. It's very easy to read. And, not only do they give us kind of an overview, but they really condense it towards the end into a few questions. So under that overview, they give kind of a background of what an ERISA Section 103A3C audit is. And then they mention that the DOL has really determined that it's the plan sponsor's responsibility to determine whether this Section 103A3C audit is permissible, which is why they're requiring the plan sponsor perform these additional procedures over that certification. So what exactly are we looking for when it comes to the certification? If you scroll down to the next page, first off, the certification must come from a qualified institution, and a qualified institution is a bank or similar institution or an insurance company, and the institution needs to be regulated, supervised, and subject to periodic examination by state or federal agencies. Now, investment companies and broker-dealers are not considered to be qualified institutions, but many of them have established trust companies that could meet the requirements to be considered a qualified institution. So what exactly does the certification look like? Well, first off, it needs to be in writing, and it needs to be signed by someone who's authorized to represent the institution. Additionally, it needs to include the phrase complete and accurate. So you can go back to question number 1 here. So they give us all that background information, then they really condense it down into about 4 or 5 questions to really make it easy to make this assessment. So the first question, is the investment information prepared and certified by a qualified institution? So they list a few of the institutions here that will be qualified: a bank, insurance company, or a trust company. Now, in some situations, an agent may be providing the certification on behalf of one of these institutions. And if that's the case, management is required to obtain that agency agreement and just determine that that agent truly is qualified to represent those institutions. So question number 2, is the certification signed by an authorized representative? So if there's any question to whether or not the person signing that certification is authorized to represent the institution, management should reach out to the institution and just obtain clarification that that person is truly authorized to represent that institution. And number 3, did the qualified institution certify both the accuracy and completeness of the investment information? So it's really important that the certification certify both the accuracy and the completeness. It needs to have that exact language. It can't certify just the accuracy and not the completeness, or vice versa, certify the completeness and not the accuracy. It needs to contain that exact language. So number 4, does the certification of the related reporting package include language that qualifies or calls into question whether the investment information is accurate and complete? So occasionally a certification may contain some qualifying language. And if that's the situation, it's the plan sponsor's responsibility to reach out to the institution and determine whether a new certification needs to be obtained or whether this ERISA Section 103A3C audit is permissible. And then the next few pages kind of go over management's responsibility as it comes to the fair value measurement of the plan assets. And we kind of discussed this a little bit earlier, that management is required to understand the measurement basis used to report investments, and that includes those alternative investments. So management should have a fair value measurement analysis of all the assets held by the plan. So this is helpful, all these paragraphs here, definitely read through that to get some more information about, the steps that are needed to be taken to really have an understanding of that valuation. And then after you complete all 5 of those steps, there's just a checklist at the bottom. It's a final question. Does the assessment, does the certification meet the requirements for an ERISA Section 103A3C audit? And then there at the bottom, there's actually some common errors that they've come across when it comes to certification. So that's definitely worth reading as well.
Excellent. So we'd like to take the opportunity now to answer some questions that we've received from the audience.
And Stephen, maybe before we do that, I just wanted to revisit a couple things on the certification. You know, we spent some time going over that tool, and hopefully you all will take advantage. We'll provide that tool because I think, you know, that will be one thing that the auditors will need to evaluate even before an engagement letter is signed for the 2021 audits. So, you know, GRF, we plan to distribute that tool early next year so that you all can walk through those steps. I'll say, traditionally a full scope versus a limited scope audit, it was all or nothing. So that, let's say you had 3 institutions holding plan assets. If one of them certified and 2 didn't, you were required to have a full scope audit and prepare full scope and have full scope procedures on all of the assets, regardless if it came with a certification or not. So this is different in that, as Andrew mentioned, the certification could exclude some assets, and you'll be responsible for having those historical full scope procedures on those excluded assets. So you'll still have the SAS 136 opinion, and it'll just specify which assets were covered and which ones weren't. So I think that's one big main difference. You all evaluating the certification is another big difference. You know, traditionally auditors haven't been required to ask management to do that. And then the other thing I'll just note on, you know, that qualifying institution, a lot of times we assume that because our assets are held with a very large financial institution, that of course, you know, of course, Vanguard is just an example, would certify our assets. Well, in most instances, financial institutions do not issue certifications. And so it's crazy to think that, you know, you have millions of dollars and historically maybe Vanguard didn't issue a certification, but maybe over the past couple of years, they have engaged with a third-party trust company who is performing that function in the agency capacity. And so, you know, really understanding where your assets are held, what each person or third party is doing and what role they play will be critical in determining whether you can even have this ERISA 103 C3A audit, A3C audit, formally limited scope. So that's something that will be new and something for you all to think about, and even ask, you know, during this year's audit, what you will need for next year, 2021 plan year, 2022 audit. So I think those are some important factors. Okay, Stephen, I think we're ready for questions. Thank you.
Yes, a handful of great questions have come through. This one on the CARES Act changes. If the plan isn't formally amended for the CARES Act changes, what other documentation do I need on file to say we adopted or did not adopt?
Yeah, so right now what we're seeing is that, you know, there could be a couple things that you have an internal memo that you've adopted the changes and will formally amend the plan as guidance and amendment becomes due. We've also seen your plan oversight committee, whether that's at the board level through a committee, or if you have a plan management that has established a committee within the minutes that they've elected to have to allow the CARES Act changes. So we're really seeing actionable items in minutes or memos at this point, or I know some third-party organizations have created just a one-page that the plan administrator and sponsors have been able to sign off saying, you know, this is an amendment and the plan will be formally restated in the future to include these changes retroactively.
Excellent. Another one here. Under SAS 136, will we need to restate our prior year plan financials for the adoption of the new standard?
That's actually a great question. Most plans will still be showing comparative information for both years. And in the year of adoption, what you'll most likely be seeing is you'll have an opinion over the ERISA 103A3C audit for the current year, where the SAS 136 was adopted. And then for the prior year, you'll actually have another opinion with that limited scope disclaimer of opinion over the prior year number. So it will be a very unusual year in the year when it's adopted, as you'll have those two opinions included.
Great. A lot of great questions on this certification assessment tool. One is, can I ask my auditor to help in reviewing the certification to determine if it qualifies for the ERISA audit?
And that's another good question. Definitely, you can definitely make inquiries of the auditors, and the auditors will be happy to provide guidance. However, it is the plan sponsor's responsibility to really go through that checklist and perform that analysis. And the auditor actually has separate procedures that they will be applying to the certification and to your analysis. So you can definitely ask for guidance from the auditors, but it needs to be from management.
And then one just snuck in here for us. If we ask for the audits from our service providers, what should we be looking for?
So I assume this is referring to the SOC 1 reports, or what would, if you've been around for a while, they used to be SAS 70 reports. Now there's SOC 1, SOC 2, type 1, type 2 reports. So service auditor organization audits. So if you're getting those, and most of the big name organizations, Fidelity, TIA, Newport, those are provided as part of the audit package, but you should have access to it online at any time. They post them right when they're available. You want to be looking, one, at the opinion. If there's a qualification in the opinion, one of the extremely large reputable organizations has had a qualification in their opinion for the last couple of years because of some significant issues. That went away this past year in 2020, which is a great thing, but you should be looking to make sure that, there's nothing within the opinion that they're not getting a good opinion that you would want to see. And then most of them, if you scroll through, the auditor has put in exactly what procedure they've performed and then an exception. It says we perform this procedure, and if there were any exceptions, they're listing them out there. So, some when you scroll through and you see no exception, and it's completely no exceptions, that you could take a look and easily conclude as management that they have good controls in place, and that, maybe you make a memo and say, we've reviewed, there were no material exceptions, and, we're comfortable with outsourcing and the level of controls that they have put in place. However, when you scroll through and you see exceptions in the reports, I would say read what those exceptions are, what they're related to. Some are more significant than others. Some might not directly affect your plan. And so for those, if there's an exception in a control that doesn't directly affect your plan, let's say your plan doesn't allow for loans and they have an exception in their loan issuance procedures or something, I'm generalizing, but if that doesn't impact your plan, or you feel it's just very minor, it might not be an issue. However, when you get into things like there are several exceptions in the samples on employee allocations, on their investment allocations, that's going to be, that's hard to justify that you all are comfortable relying on them 100%, because obviously they're the auditors found issues in a small sample. So with that, I would say if you are scrolling through and you see exceptions, make a judgment call on whether it's going to directly and materially affect your plan. And then two, if there are things, then you all as the plan sponsor would ultimately be responsible for putting in mitigating controls. So if there is an exception in the allocation, maybe you periodically do quarterly internal audits of that for your specific plan, because obviously their exceptions are not just for your plan, it's for everything that they hold. So I would say, you know, that just justifies maybe another step on the plan administrator side to check that they're doing what they're supposed to be doing if there are significant issues.
Excellent. Well, with that, we would like to thank everyone for attending today's discussion. We encourage you to follow us on social media at GRF CPAs and visit our website at www.grfcpa.com for upcoming events and alerts. Please remember to complete the survey that will appear automatically following the session if you would like to earn your CPE credit for attending today's seminar. Thank you again and have a great day.
All right. Thank you, everyone. Take care.